All right. I'm about 10 minutes behind all day. Good to see you all. It is the final hour, 0 days to expiration. And today we have a special treat, a very special treat. And that is that we're embarking on a new path here at 0 days to expiration. It's actually not a new path. It's an old path that's not very worn. And so we intend to wear in that path by doing another experiment. Now, I'm sure if you've been following this channel for a while, you know that what we do here is we develop new ways to trade 0 DTE. And sometimes those experiments are very successful, and sometimes they're meh, and other times they're, well, forget about that one. We haven't had actually any forget about that ones. Well, kind of. It was the meh, and that's still a forget about it. And that was the final hour trade, as a matter of fact. It went very well for a period of time. We did 100 trades, very well for a period of time, and then it just sort of fell down. And so now we are looking at or revisiting another type of trade that we actually did last year. Now, I want to make it very clear that anything that we did last year is all great, and we learned a fantastic amount about trading 0 DTE last year. But it was kind of like operating in fantasy world, because last year the market just went up. And essentially, the trade was to go long, or put an out of the money butterfly long, or wait for a pullback and then put the out of the money butterfly long. And occasionally we might do a short trade. I don't think the shorts really worked out that well, but the longs, man, they were just out of this world. And we went that way and tried also other types of trades that probably we shouldn't have. That had marginal success, but that one trade was fantastic. Out of the money butterfly, a good, a 1 to 7 to 1 to 10, sometimes as much as a 1 to 15 risk to reward. You imagine that? We put on a 1 to 15 risk to reward, but because of the nature of the market last year, it seemed like everything stuck, you know? And with this strategy, if you're only putting on one trade, then you can probably expect approximately 50% win rate. And that's because nobody knows which way the market's going to go, except for last year. It just went up. And so the win rate that we had last year was anywhere from 65% to 95%. We had 95% for one stretch lasting 6 to 8 weeks or something like that. It was insane. We'd had pin trades every week, sometimes twice a week. Yeah. And so everything that we did there, it was like diamond hands. So when January rolled around, obviously, as you all know, the market had a very different complexion. And the old strategies, while they worked, they didn't work with the same gusto and veracity. They just wasn't there. So we actually had to start thinking a little bit more about how we put those trades on, how we manage the profits, and how we couch or compartmentalize the risk. And so that's what we did. And instead of making, say, 11 to 20% a month like we did last year, without even trying, this year I've been able to eke out about a 6, and this is not bad by any means, it's actually great, a 6% return, approximately about 5 to 6% return per month. But, you know, working at it, it takes some work and takes some concentration. And we can have several days in a row where you can have losses, but you keep up with the strategy, you apply it every day, and as you would expect from a strategy that has about a 50% win rate, you're going to have streaks of losers and streaks of winners. Now, the streaks of losers, if you understand the long-term return aspects, the long-term expectation of the strategy, should really pose no problem. But with a lot of people that are coming into this service new, fresh, without any exposure to this type of strategy, which is quite different than, say, the high probability strategies that they might be used to, that most retail traders are used to, it can be a shock. Even though the risk is so super small that it shouldn't bother you. In fact, even when we had long streaks of losses, still the maximum drawdown was about 3.25%, which is nothing. It's just really, really very small. So that still doesn't work well with some people. Some people can't take 3 losses in a row, which is crazy. So anyways, I've been doing a lot of reading lately, and I've been particularly interested in some of the older work by Benoit Mandelbrot. And you may know him from Mandelbrot sets. Those are those really cool screensavers that no matter how deep you go into it, it keeps on getting more and more complex. Or fractal geometry. He also did quite a bit of work with volume and memory systems, or systems that have long-term memory. And so I'm, and one of his other very interesting things after I read this academic paper of his is this concept of trying to think of a really good way to, to put this. A long-term memory. Compresses. Okay, I got it. Basically, what he was trying to explain was that markets don't. I'm going to try to summarize how he put it. Markets don't work on real time. And you might think of that and go, what does that mean? And this has a lot to do with fractals and the nature of markets, how you can basically see the same kind of patterns no matter what time frame that you're on. And what he meant was that markets don't work on real time, they work on market time. And that time from a human's perspective may be very different. For instance, you could see a pattern over the course of a few days and recognize that pattern, like a head and shoulders or a flag or whatever. But if you were to take that same pattern and then compress the time to, say, 1/10 the size or 10 times the size, that pattern would no longer be recognizable. All right, so bear with me right there. And so because of that, it's difficult to see the pattern, and it's difficult to play it if you can't see it. And one thing that I noticed is that we work and operate in the same kind of thing. I'm putting on these trades once a day, and if you were to look at the equity returns, you get a certain return, but it's all based on this metronome of time. One day, one trade, one day, one trade, one day, one trade, one, etc. But the market doesn't care about that. So we could essentially be getting the same kind of performance, or what the market is, what you would expect from the market, but you don't see that in the equity curve until you either compress or expand it. And this compression and expansion can happen in any kind of interval. I know that this is really tough to explain. That's why I was thinking, how am I going to explain this? So anyways, what it means then is that you could have these several days or streaks or clusters, as Mandelbrot defines them, that could be persistent or last a long time or be very short in duration, but in the long run, there's no difference in terms of the overall market cadence. Hope this makes sense. So anyways, we trade, the basic strategy here is to trade a single butterfly out of the money with a certain risk to reward each day, one of them. And if you were to then put those on, and then over a long time, you have this very nice equity curve that goes from bottom left to top right in kind of a stair-stepper way. Sometimes the streaks going up seem like they're a lot longer. Sometimes they're shorter. Sometimes the sideways action, the step, is long or compressed. And that is kind of reflective of this. But from a market point of view, they may all be basically the same thing. Or like if you were to put yourself in market time, it would all look like a very regular pattern, not sort of this waving, undulating, streaky type of thing. So there's got to be a way then to change this. And then I had this idea that goes back to my my hedge fund and institutional trading days, and starting to look at algorithmic systems and which type of algorithmic systems work. When you're looking for like an algorithm that works, it's virtually impossible to find any single algorithm that works. And this is employing sort of the same idea, because each algorithm is in its own time. However, if you were to put two algorithms together that were relatively uncorrelated and run them together, then all of a sudden those two tend to work because they're out of sync with one another, or they're in a different time frame. And so what turns out to be, a wild curve on each one of them, equity curve like this, when you put them together, it gets very regular like this. And so I thought, well, maybe that's our issue too. So imagine that you had, and I also discovered this when I was looking at simulations of the system that we trade. And so I've created an application in Excel that simulates how we trade in terms of the risk to reward and the chances that we take and all the different other factors that go in. And then you can run it, and it will produce 500 trades playing a particular way. And then you can run it again, and it produces another 500 trades. And although in general, if you were to average all the instances that you run this, it would look similar. There are all kinds of shapes to the equity curve. Some of them going straight up like this, some going like this, some going like this, but most of them were pretty good. And I thought, well, maybe that's the answer. That it's not about a particular trader and how many trades that they put on. Just one trade after another after another. It's really about looking at each trader as if they are two sides of the coin. You have to put them both on at the same time, and they are like living in separate universes. That if you could put on a trader that goes bullish in the morning and a trader that goes bearish in the morning, and you set them off, if you ran them independently of one another enough times, they would all have completely different approaches to the market and different equity curve, different shape, all that stuff, even with the same market. And I showed this in my simulations, that even with the same market, you can have different results. So I thought, okay, since we really don't know which way the market's going, maybe it makes a lot of sense to play both sides of the market. That way we don't have to guess. Now, this may sound eerily like some other zero DTE strategies where they don't actually play both sides of the market, but in a way they do. They put on very wide iron condor, and it's not that they're playing both sides of the market. They will take exorbitant risk to try to capture all the possible market behavior. Where that's not what I'm talking about at all. I still want to capture the different types of market behavior, but I don't know which way the market's going to go. So the idea here then is to put on a trade a bullish trade and a bearish trade. And where we would normally wait for the market to kind of reveal itself in the morning to try to get an edge on which way it might go, which turns out that we really can't. Even if we wait and see where it's going to go, it ends up not going that way anyways, or 50% of the time. It's crazy. I know. I'll just ignore that. I'll just put on both a bullish and a bearish trade and let the market decide where it's going to go. And if the risk to reward is great enough on each of the individual trades, then it won't matter. I'll still have that benefit of that asymmetric trade. And all the other stuff will take care of itself. The other thing that it will eliminate, or almost eliminate, except for in some very rare edge cases, and that is the the risk that you're going to entail, this tail risk, where you have clusters or streaks of losers. Because if you had a streak of losers on this side's going to act differently, right? And it almost has to act differently because it's on the other side of the coin. So if this side is acting differently than this side, then the average of the two is going to look somewhat better overall. Consider also that both of their curves look fine, but both of them together look really fine. So that's the concept. And hopefully I'm describing it correctly. And in doing this, you are eliminating the market time aspect, because the market time aspect, if you're imagining two systems, one's, right? And then this one over here is doing something like, you put them together. I know, it's very technical. You put them together, and then you get something that is more self-correcting and different from the other. It's different from the sum of the two, but it takes away a lot of that inherent volatility in the returns. Now, I don't know if how you would do more of these. I don't know what's beyond the binary exception of going bullish and bearish, what else you can put on there. I suppose you could also put on a neutral strategy too. And maybe that's an idea. You put on a very narrow neutral strategy right in the middle of the two. Man, that sounds good. Interesting. I think I'm going to follow up with that. So that's what we're doing right now. We are employing another experiment. And of course, we'll be sharing it with everybody out there. We'll be showing our trades live, like we always do. Where before we were showing the final hour trade, I'm wondering if I should do a mid-morning trade of showing how, what the result of us getting into it after we've gotten into it would be more useful. And then I got to think about that. I don't want to do two public live. I got to do a private show with the service so that we can talk about service business, and then a public show to basically expose or be totally transparent about this new strategy. So I got to think that one up. I have to think that one over and figure out what's the best time to do this if I have to change things up a bit. But that's essentially what we're doing. We are doing this new strategy that we call the Batman strategy. And it's called the Batman because, there are two butterflies on either side like this, and they kind of look like Batman's ears. And it's quite a bit more complex than that. And what we're trying to learn from this are the edge cases and how we actually manage those, because it will be a little bit different than what we do when we only have one trade. I mean, basically what we did with just one fly was ignore the risk because the risk is already defined. Now that we have double that risk because we have two of these on, now I don't even know exactly what shape that will look like. Then there is a small amount of management, or maybe there isn't. I don't know. But we'll learn about that. And we'll learn about what's the best time to actually take profit on these trades, because now the one that's being in profit will also be hindered or demoted a little bit from the risk from the other trade, and then vice versa, right? So we're going to have to look at that as well, and we'll do all of that, like I said, in an open forum, in an open way, on how we're going to be executing this, and then we will be developing this trade internally, and that will potentially, if all works well, it may become the mainstay trade that we do, or a variation of it. So that's what we're going to do, and that's what I'm announcing here today. So hopefully that makes sense. All right, let's. Why don't we do a roll call, find out who's here and what's going on, and we'll take a look at the current Batman trade, the very first one that I put on, and see whether or not that's coming into its own. All right. All right, so we have Brent. How you doing, Brent? Hey now. And Jay Hen. Good afternoon, all. I hope all is well in Gotham. That's right, because Batman is from Gotham City. And Giannis is here. Nice to see you, Giannis. Is that a child photograph of yourself? I don't know. And hello, Squared from Iz. Nice to see you. Will Do is here. Will Do's very friendly guy. Dan Smith, nice to see you, Dan. Dan is our resident developer. And Jim S., how you doing? Jim, just so you know, I know that I missed the YouTube membership live stream today. However, what I did was I took our current live stream that we did today, I edited it down, and then I put it into your Dropbox in the YouTube membership. And there'll be more. Is Gloria? Nice to see you, Gloria. Thank you for coming. And Robro, what's up, Zeros? Leonardo Novara. Hola, saludos desde Buenos Aires. Oh, from Argentina. I just totally munged my Spanish there. I did take Spanish when I was in high school, but that was almost 45 years ago. If you can imagine that. Wow. Miko's here. Yo, Mike. Oh, please, can you speak slowly? I will give it my best shot, Gloria. Usually I do speak very deliberately. And so I'll do my best to speak slowly so that you can understand. And that's an interesting point, Robro. Use the gear icon to reduce YouTube playback speed. But that doesn't work in real time, Robro. Wouldn't that be cool? Here I am talking about market time, right? Only if you in real time could speed or slow down time. Wouldn't that be quite a trick? But that's only the playback. And Iz is chiding in on that. And Gloria says, thank you. We have Jonah. I like the midday trade analysis idea. So maybe that's one vote for midday, to perhaps maybe at noontime do this. That's probably a good time to do it. So we can review the trade after we get out of the Zoom meeting with the group, and then we'll review the trade for public scrutiny. How you doing, Jonah? Don H. is channeling old classic Batman shows. Bam! Pow! Crash! With his fights with all of the minions, the Joker or the Penguin minions. All of them had minions. Catwoman even had minions, and so did Mr. Freeze. Mr. Freeze. Who was Mr. Freeze in Batman? Who was the Joker in Batman? Who was the Penguin? Who are the classic actors that played those roles? There you go. There's something for you to chew on. Let's see. Jonah says the TOS Analyzer tab is still confusing to me. Need practice reading it. Okay, we'll do some sessions on the TOS Analyzer in the Zoom room. Just remind me of it. Okay, that's it for now. I'm sure there'll be many more. If you're out there and you like the content, please hit that like button. I really appreciate it. So what we'll do now is we'll go to and examine our first Batman trade. It's not really our first, but it's the first in this experiment. And then we'll come up with a way to do this so that everyone can join in on it. All right. To the charts. All right. So I'll get rid of this guy here. All right. So what you're looking at are, this is the market. This line is at the close of each bar. You know, we're looking at a 3-minute time frame. And the market opened right here. Right there. And when the market opened, I put on 2 trades equidistant from the open, out of the money but equidistant. A bullish one, which is a call spread, and a bearish one, which is a put spread. Both of them are 20 wide. And so both of them are 20 wide and approximately anywhere from 1 to 5 or 1 to 7 risk to reward. So that's part of what we're going to be looking at is, you know, what makes the most sense. Do we want to minimize the risk to reward, you know, keep it at 1 to 4, 1 to 5, or maximize it, go for 1 to 7 to 1 to 8? A 1 to 8 risk to reward would spread them out from each other a bit more and require a little bit more expected move in the market. Today, I mean, if you look at things, we're almost right back where we started, very, very close to the starting point of this market. So this is actually an edge case for us. So that'll be one of the considerations, you know, how wide to make, how far apart, not how wide, but how far apart to make this, and also how wide. I mean, because that could also come into play. And as I had mentioned earlier, maybe there's the opportunity to put a very narrow one in the middle too. I haven't even thought about that, but that might be something that we look at as well. So putting them, you know, equidistant from the open and putting on right at the open is a very different thing that we do currently. This is basically saying that we have no idea which way the market's going. Wherever it goes, if it falls inside of these, we're going to be doing okay. If it falls right in the middle of these, then we have to employ some sort of, maybe some sort of mitigation strategy. All right, so that's part of it. And if it falls outside, if price ends up outside, well, that's an edge case. So there are basically 3 edge cases. Falls right in the middle, or it falls outside on either the top or bottom. So we'll look at those, and we'll gather data on that. We'll look at trading the SPX, the E-mini, and the XSP, which is the micro SPX, under each one of these conditions. So I would imagine that each of them will have their own characteristics, but basically be the same. Of course, the XSP is 1/10 the size of the SPX, so we have to do a little bit of rounding with that, right? Can't, it's hard to divide a one strike 10 ways. All right, let's see here. So today, as you can see, we've basically been going sideways, doing nothing, which is very unusual considering even in this past market. And this past market has mostly been going sideways. But if we were to take it over the last, let's see. All right. So what I'm doing is I'm just showing the last, all of last week. So that has been mostly sideways when you think about it. Just all, here's the volume profile. You can see it very clearly that the vast majority of action has happened in a very, very narrow band. And so that's caused quite a bit of, well, very, not quite a bit. That has caused us to be, you know, I don't know what the word is for it, but you know, there hasn't been huge opportunity, but there has been some opportunity. And one thing that I had noticed that was very telling, as you may know, when we've been talking about the butterfly before and the out of the money butterfly, that a lot of times we're looking to take profit even outside of the butterfly. As a matter of fact, that's the majority of our trades, and that is mostly because those are the opportunities that are presented to us when we only have one fly on. Now, when you have two flies on, I guess you know the opportunity for taking it out of the money or outside the butterfly tent is going to increase. You would think, but I don't think so. I think that there's going to be a difference there, because one thing I notice is that if we didn't make it on one side, that a lot of times price moved to the other side and went deep into the fly. So that's an interesting point. You can see it here on Monday where it never reached. Now, just so you know, the darker fly in each case was the fly that I chose as our primary butterfly to put on. And usually because of market action or price action. So for instance, here we had price action that indicated or appeared to indicate that price would go up. And it started to, but then it went down. And it was there long enough for us to make a small profit without ever getting inside the fly. However, had we taken the downward action, and because it landed inside of the put fly down here, we would have made much more profit. Same thing happened up here. Again, because of the overnight action and coming into the open, it certainly appeared as if we were going to continue up to this fly, and it stopped cold and went deep and directly to the middle and almost closed as a pin trade on this strategy here. Then this is on Wednesday where it did neither. It was an edge case, and we really placed these flies pretty far away. So I don't think it would have made a difference even if this fly here was closer. We still would have missed out on this. It just stayed. It looked like it was going down. Prices coming in here, coming down. Look at this trend from here yesterday all the way to here, and this open. You think it's going to go down, but it never did. And instead, it just stayed the same. And then the same thing with this guy on Thursday, coming down hard overnight. And what does it do? It stops. It doesn't ever reach here and nearly pins on this day too. And then finally on Friday, I got smart and said, okay, it's coming up. And normally I would choose this guy up here, but I've been burned 3 times before. So I'm going to say I'm going to take the bearish trade. Just a guess. That's what it was. It was a guess. And on Friday, we got nearly a pin trade. So while the week wasn't bad, I mean, we won 3 out of 5 trades, maybe in some cases 4 out of 5, depending on how you count that. It wasn't bad, plus a big winner at the end of the week. You gotta love that. However, had we taken both sides of the trade and played it right to expiration, we would have had 4 pin trades. 4. And instead of making a few $100s, we would have made, now, this is my calculation, so I might be wrong, but it would have been over $4,000. And I thought to myself, okay, maybe that's an anomaly. Maybe that doesn't happen all the time. Maybe last week was, just one of those outlier winning weeks. And so I went back and I checked it on random weeks all the way through by doing some forward walking. So you're probably wondering, what in the world is forward walking, Ernie? Well, that's where you go and pick a date, any date in the past. You don't look at what the price action was. You have no knowledge of that. You just get into your platform and you set its Wayback Machine to that time. And then you employ the strategy as if you're there way back in time. And then you test the strategy out. And you do this for a wide number of dates randomly chosen, just so that you can start trading from your perspective what would be out of sample data or data that you've never seen before. And unless you had a photographic memory and were able to go back and know exactly how the market behaved that time, and nobody really, maybe some people do. I'm not a Rain Man. But I can enter a trade back on, say, I'll pick a random date, June 19th. If I don't even know if that lands on a weekday, but let's say it does. And then start trading it with this strategy. Well, I've done that several times, and every week that I've traded has been incredibly inspiring on the results. So I've decided, and well, I guess we as a group, after I introduced it, we're going to experiment and explore this trade more fully. When I started thinking about it, given what I told you before about market time and taking two parallel traders in what, for all accounts, may appear to be separate universes, and then having them trade on the same day, but just on different sides of the fence, how would that fare? And so that's what we're going to do. Now, how many trades should I devote to this? How many days? I don't know, but it's probably going to be significant, and we'll see. Let's see, Tim says, butterfly trades are great. As price moves towards it, you get in nice profit. Be sure to take profits before it moves away. Yeah, and in this case, you may not have to worry about that, Tim. So that's one, at least with some of those cases. Jonah says, it's difficult to see the close price in the dark background and the tense or the volume profile on top line. Can you please put a marker? All right. Maybe what I'll do is I'll take the price and I'll make it a different color. Let's see, how can I do that? The settings isn't coming up. I'm sure it's somewhere. Yeah, I don't see it. I'll work on that, Chona, and get back to you. But right now, the settings are not coming up for some reason. I can't get to the settings when I right click. It's not coming up. I might have to restart the app. Let's try that. There we go. So what I'll do is I'll make the line yellow. and thick, so it's easy to see. There's the closing price. Maybe I'll make it a slightly different color. That might be just a little bit too much. There, that's good. So the squiggly line is the closing price of the market. All right, so that might make it a little bit easier to see it. Yeah, I already tried that, Robro. It wasn't being responsive. I had to restart the app. Mr. King says I can do 1 DTE as well, right? We've looked at 1 DTE. I've looked at it, and I think that there's better risk to reward opportunity for 0 DTE. I don't think that you get enough extra premium from doing it one more day out for the extra risk that you're taking on. So from that point of view, I think that, and plus the overnight risk, I don't like that. So I think that doing it just a single, now I may be wrong. We've done that in the past and we've had success with it. And maybe that will be one of the other experiments that we do in the future. I don't know. All right. But this price has been really stubborn, does not want to go back down there, wants to stay. Let's see if I can adjust that. Yeah, almost exactly at the open. This was the open right here. Yeah, it's right at the open. Isn't that incredible? So that would be an edge case for us. You know, what I'd like to know is how often does the market close at the open? How often does that happen? Let's look at this at the candles. Yeah, I don't, the candles get kind of messy. Having the line seems to make a lot more sense. Interesting. So this is an edge case. Well, first of all, there are 2 edge cases here. One is that early on in the day, we got pretty deep into this, very close to the center strike. Let's see. Although it's hard to tell from this because it's not showing the tail. So, the center strike is down here, but the tail went very close. It came all the way down to here. So when it got all the way down to here, the value of the center strikes here was almost completely depleted. In other words, they had maxed out on the returns that they could possibly give. 2 short strikes from here. And so when we got down here, that type of edge case would have been significant. Now, let me tell you why. Because if you had bought back the shorts of this call fly up here, when price got way down here, you could have bought it back for a very cheap amount, maybe $20 or something like that. Then on this move up here, the remaining call strike, long calls, would actually become much more valuable. And you could have removed that with a pretty good profit that would have easily offset the debit that you incurred from the put fly. So that's one case. The other case is that we're in the middle here, which is a kind of a max loss potential, and that's because you're getting the loss of both this fly and this fly combined, and so its premium is decaying at its fastest right there. So that's another very interesting case. And you don't want to be there right at the very end. You would likely get out somewhere around 130 or so, which would have been around here. So I'm showing two different cases here. One where we could have bought back the. So these are alternative strategies that we're talking about and have examined when you get into these different cases, the type of management that you can do for profits. So one of them is that when you move far enough away from the opposing trade, you can buy back the shorts in the event that you have a reversal, and then you can take advantage of that reversal because now you've already extracted the max value out of the shorts, and now you can also get value out of the longs. So that would have been a possibility. And then the other is that is more of a timing thing, that if price were to stay right on the center strikes, which for the most part it did, it was in the center strike in the beginning. I'm sorry, the strike, the entry, the open, and then for a good part during the afternoon, you could have got out anywhere in this frame and get out with minimal, very very minimal loss, maybe 1/5 to 1/8 of the total risk. And so even if this trade ended up right here, right at the center strikes where it's max loss, you could have still achieved a nice profit off of it. So that's an edge case where it's the worst case scenario. That's what I'm looking. That's why I'm mentioning it. The very very first trade we put on happens to be the worst case scenario, and it still could have churned a profit or at least gotten out with absolute minimal loss. So that's one thing that's very encouraging about this, and that's really the power of having these two opposing strategies that again, you have to look at them as maybe two universes flying by in the night, two traders flying by in the night. They don't know of each other, yet they influence each other. All right, Iz wants to know how often market closes within a short range of the open in recent past to account for current conditions. That's a good question. I saw somebody show some data on market closes, and we'll have to do it ourselves. It'd be a fairly simple thing to do. You can go to Yahoo and look at the SPX history of data, and we could download the closing data for the past 30 years from there. And I'm going to say that closing, within 1 point, 5 points, 10 points of the open, we'll have to take a look at that. But I would suspect that that's a fairly rare case, each of those. All right. So we'll have to take a look at that. The data that I saw was, how often does it close? 1/4%, 0.5%, 0.75%, 1%, 2%, 3% of the open. All right, Don wants to know, what does the profit line look like in the afternoon? What does the profit line look like in the afternoon? I don't know. I don't know exactly what profit line we're talking about. Oh, it looks fairly slow. Oh, you're talking about the profit line of the fly. All right, let's take a look at that. All right, that's what it looks like right now. So right now, even right now, I could get out without a max loss. About 2/3 of the total available profit or available risk. Well, now about 4/5. But if price moves down, I mean, we could, conceivably be anywhere along this line. If it moves to here, then there will be no loss. But we'll see what happens. I'm using the XSP because, it's super small. So we actually stopped right about here, which is a little bit less than the max loss. Not much less, but a little bit less. Well, that would be the, okay, you can even look at the daily candles and how many are near dojis. That would be an easy way to pick that off, I'm sure. And that's a good idea. But you could also just download the data from Yahoo and put it into a spreadsheet and then get very, very specific numbers and ranges of numbers very quickly. I think that's what I'll end up doing. All right. So there you go. There's our work cut out for us. That's what you can expect over the next, I don't know how many shows, but we're going to start talking about the strategies that we're exploring here and what we find from it. And I suspect that we're going to find some very good things because we're taking all the best parts of our current strategy, which is very, very strong, and by putting it side by side with an anti-trader, it should make it even stronger. Now, I don't know if it's going to be 2x strong or 1.6x strong or whatever, or 2.5x strong. That's what I don't know. But I do know that it will be much stronger. And so, of course, there's probably going to be a little bit more work. Maybe. That's what I don't know yet. And that's what we're aiming to discover by taking on this experiment. All right. So, let's see. Tim says the SPX closed within a couple of points of the open. I know, it's crazy, huh? Absolutely crazy. That's gonna, that can't happen very often. That just does not happen very often. Worst case scenario happens on the very first day. That's, that's precious. So precious. All right. Let's bring back the big head. How you doing? That was fun. Today was fun. We'll do some more of this every day. And of course, we'll do our regular trade too. We'll pick one side or the other. And this trade, I'll be following along. I want to follow along with each of the types that I put on. So I'm looking at all the types. So here's the SPX version. Come on. All right. Now, see, that would have been a big loss. $550 loss. You don't want that. Wow, everything's moving so slow. All right. We will look at that later. My Thinkorswim is moving super slow. All right. So learned a lot today. And we need to do a lot more work. We need to find out, first of all, do our data studies and figure out what is the expectation. And of course, doing historical work will give us averages and all that, but that won't say anything about what's going to happen that day. However, it will give us an idea of how often that we have to, or how often, at least in the past, we've had to employ certain types of strategies, and whether or not that makes it a viable strategy or not. And I'm, just from what I can see, it's just not anywhere close. I think it's going to be a very, 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 very nice situation, particularly when you're talking about putting together these two uncorrelated universes together. I think that's going to make a big difference. Now, I know you're probably thinking, well, that's the same thing. They're both correlated, but they're not. Not if you look at it as two separate traders that are employing strategies from different perspectives. So it'll be cool. All right. Well, that's about it. Peace to you all. Thank you very much. And we'll see you tomorrow. Time for the music.